EPK Capital presents Deep Dive, Chevron Corporation. Hello everyone, welcome to EPK Capital's Deep Dive video. I am your host, Rutvik. In this series, we analyze one company each day based on the security analysis by Benjamin Graham. Today we are going to talk about Chevron Corporation. Before proceeding, it is important to state that this report is for educational and informational purposes only. It does not constitute financial advice, and it is not a recommendation to buy or sell any stock. All investment decisions should be made after conducting thorough personal research. The anatomy of a giant: company, operations, and leadership. To properly analyze any company, one must first understand its identity. For Chevron, that identity is deeply rooted in the history of the American oil industry itself. Its operations are vast, its leadership is seasoned, and its ownership includes some of the most influential names in finance. A legacy forged in oil, from Pico Canyon to global Supermajor. Chevron's story begins not in a corporate high-rise, but in the rugged terrain of Pico Canyon, California. In 1876, a group of explorers successfully struck oil, and just 3 years later, in 1879, Chevron's earliest predecessor, the Pacific Coast Oil Company, was incorporated. This modest beginning set the stage for a century of transformation. In 1900, the burgeoning company was acquired by John D. Rockefeller's formidable Standard Oil Company, integrating it into the largest and most powerful corporate entity of the era. A pivotal moment came in 1911 when the U.S. Supreme Court mandated the breakup of the Standard Oil monopoly. From these fragments, a new, autonomous entity emerged: Standard Oil Company of California, or SOCOL. SOCOL was one of the original Seven Sisters, a group of dominant multinational oil companies that controlled the global petroleum industry for much of the 20th century. The company's modern identity was forged through a series of strategic and transformative acquisitions. A massive expansion into the Middle East in the 1930s established its international footprint. Then, in two bold moves, SOCOL devoured two of its fellow Seven Sisters. The 1984 acquisition of Gulf Oil was, at the time, the largest corporate merger in U.S. history. It was after this merger that the company adopted the name Chevron Corporation, borrowing from a popular gasoline brand it had used since the 1930s. This was followed by the landmark merger with Texaco in 2001, further cementing its status as a global supermajor. The latest chapter in this long history of strategic consolidation is the recently completed acquisition of Hess Corporation, a move designed to secure access to the vast and highly attractive offshore oil discoveries in Guyana. B. The Chevron engine, a vertically integrated powerhouse. Chevron operates an integrated business model, meaning it controls assets across the entire energy value chain. This structure is divided into two primary segments that provide a natural hedge against the volatility of commodity markets. The upstream segment is the foundation of the business. It involves the exploration for, development of, and production of crude oil and natural gas. Chevron's upstream operations are global in scale, with major production hubs in the prolific Permian Basin of Texas and New Mexico, the deep-water Gulf of Mexico, and significant international sites in Kazakhstan and Australia. The addition of Hess's portfolio brings the world-class Stabroek Block in offshore Guyana into this core group, a key driver for future growth. In 2023, the company produced over 3.1 million oil-equivalent barrels per day. The downstream segment takes the raw materials from the upstream business and refines them into finished products. This includes refining crude oil into gasoline, diesel, and jet fuel, as well as manufacturing and selling lubricants, fuel additives, and petrochemicals used in countless consumer and industrial products. These products are then marketed and distributed through a global network, including the familiar Chevron-branded service stations. This integrated model means that when crude oil prices are low, which hurts upstream profits, the cost of raw materials for the downstream business also falls, often leading to improved refining margins. This balance helps smooth out earnings through the commodity cycle. C. Leadership and ownership. Who's at the helm? Chevron is led by Chairman and CEO Michael K. Mike Wirth, a company veteran who embodies its deep operational culture. Wirth joined Chevron in 1982 as a design engineer after earning a degree in chemical engineering. He ascended through various leadership roles in the company's global operations before being appointed CEO in 2018. His long tenure and technical background suggest a leadership style grounded in operational efficiency and disciplined capital allocation. The ownership of Chevron is dominated by large financial institutions, which hold over 60% of the company's shares. This high level of institutional ownership provides a degree of stability to the stock. The top shareholders are a who's who of asset management giants, including the Vanguard Group, State Street Global Advisors, and BlackRock. Notably, one of the largest and most influential shareholders is Warren Buffett's Berkshire Hathaway. The presence of Berkshire Hathaway on the shareholder list is more than just a data point. It acts as a powerful signal to the market. Buffett is renowned for his long-term, value-oriented investment philosophy, focusing on companies with durable competitive advantages, strong management, and robust cash-generating capabilities. The fact that Berkshire has not only maintained but recently increased its multi-billion-dollar stake in Chevron suggests a strong vote of confidence in both the company's management and the medium-term prospects of the traditional energy sector. This concentration of patient capital from large institutions, anchored by a prominent value investor, implies a shareholder base less prone to panic during periods of market volatility, affording management the stability to execute on complex, long-cycle capital projects. 2. Financial Deep Dive, a 10-year performance review. A look at Chevron's financial statements over the past decade reveals the story of an industry defined by cycles of boom and bust. However, beneath the volatility of revenue and profit lies a consistent theme of financial discipline and a steadfast commitment to shareholder returns. A. The revenue and profit roller coaster. Chevron's top and bottom lines are inextricably linked to the global price of oil and gas. The 10-year period from 2015 to 2024 perfectly captures this reality. The decade began amidst a severe downturn in commodity prices, which pushed the company to a net loss of nearly $500 million in 2016. This was followed by a period of recovery, only to be disrupted again by the global pandemic in 2020, which saw demand plummet and resulted in a staggering net loss of $5.5 billion. The subsequent recovery was just as dramatic. As global economies reopened and supply constraints emerged, energy prices soared, leading to a record-breaking year in 2022. Chevron posted a massive net income of $35.5 billion on revenues of $235.7 billion, its most profitable year in over a decade. The years 2023 and 2024 saw earnings and revenue moderate from these historic highs, reflecting a normalization of commodity prices, but still representing a healthy level of profitability. This history underscores the cyclical nature of the business and the importance of analyzing performance over a full cycle rather than a single year. B. Profitability and efficiency. A look at margins and returns. The company's profitability metrics, such as operating and net profit margins, mirror the revenue and income trends, expanding significantly during periods of high energy prices and contracting during downturns. A more telling metric of long-term performance is return on equity, ROE, which measures how effectively management generates profits from the capital invested by shareholders. In the banner year of 2022, Chevron's ROE exceeded 23%, a testament to its ability to capitalize on favorable market conditions. In more typical years, this figure is lower, but the company's focus remains on maintaining a competitive return through the cycle. C. Balance sheet strength and cash flow generation. Perhaps the most critical aspect of Chevron's financial story is its balance sheet and cash flow. The company is renowned for its financial prudence, consistently maintaining one of the strongest balance sheets in the industry. Over the past decade, its debt ratio has remained at conservative levels, providing a crucial buffer that allows it to navigate commodity downturns without jeopardizing its long-term plans or its dividend. At the end of 2024, its net debt ratio stood at a very healthy 10.4%. This financial strength enables the company to be a prodigious generator of cash. Cash flow from operations is the lifeblood of the company, and after subtracting capital expenditures, what remains is free cash flow, FCF. This is the cash available to reward shareholders. In recent years, Chevron has transformed into what some analysts have called a cash-gushing juggernaut. In 2022, it generated a record $37.6 billion in free cash flow, and even in the more moderate environment of 2024, it produced a robust $15.0 billion. D. Shareholder returns, dividends, and buybacks. Chevron's management has a clear and consistent capital allocation strategy. Its first priority is the dividend. The company boasts a remarkable track record, having increased its annual dividend per share for over 37 consecutive years, earning it the coveted status of a dividend aristocrat. This makes the stock a cornerstone for many income-focused investment portfolios. After funding the dividend and its capital expenditure program, the company returns excess cash to shareholders through substantial share repurchase programs. In 2022, for instance, the company returned $11.25 billion through buybacks, and in 2024, that figure grew to $15.2 billion. These buybacks reduce the number of shares outstanding, which increases the ownership stake and earnings per share for the remaining investors. The following table consolidates key financial metrics from the past decade, illustrating the company's cyclical performance and its unwavering commitment to its dividend. Valuing Chevron, an application of the Benjamin Graham formula. To move beyond the stock chart and assess the company's underlying worth, it is useful to apply a valuation model. One of the most famous is the formula developed by Benjamin Graham, the mentor of Warren Buffett and the father of value investing. While it has its limitations, it provides a disciplined, fundamentals-based framework for thinking about intrinsic value. This calculation results in an intrinsic value range of roughly $93 to $118 per share. At a recent market price of around $157, this classic valuation model suggests that Chevron's stock may be overvalued. C. Important caveats and context. It is crucial to frame this result with the proper context. Benjamin Graham himself was deeply skeptical of forecasting future earnings and included a footnote in The Intelligent Investor clarifying that this formula was not a direct recommendation for investors to use. Rather, he presented it as a way to model the market's embedded growth expectations. Therefore, the Graham formula should be viewed as a valuable thought experiment, not a definitive price target. Its primary utility is in anchoring an investment decision in fundamental metrics, earnings, growth, and the alternative return available in high-quality bonds. The calculation demonstrates how sensitive a stock's valuation is to assumptions about future growth and changes in interest rates. The discrepancy between the formula's output and the current market price highlights that investors today are either anticipating higher long-term growth, are willing to accept a lower rate of return than this conservative model implies, or are valuing the company based on other metrics, such as its substantial and reliable dividend yield. V. The investor. Debate. Pros versus cons. Investing in Chevron today involves weighing a compelling case for its financial strength and shareholder returns against significant long-term risks tied to the future of energy. A. The bull case. A cash-gushing dividend machine. The arguments in favor of investing in Chevron are clear and powerful, centered on its financial prowess and strategic positioning. Elite free cash flow. As major capital expenditure cycles wind down and new projects come online, Chevron is poised to generate massive amounts of free cash flow. This FCF is the engine that powers shareholder returns and provides financial flexibility. Disciplined capital allocation and strong balance sheet. The company is known for its capital discipline, prioritizing high-return projects and maintaining a fortress-like balance sheet. Its low debt levels provide resilience during industry downturns and allow it to act opportunistically. Reliable and growing dividend. For income-oriented investors, Chevron's 37-year track record of consecutive annual dividend increases is a primary attraction. The dividend is management's top financial priority, offering a dependable and growing income stream. Strategic growth with Hess Guyana. The acquisition of Hess is not just about adding production, it's about adding a long-term growth runway. The Stabroek Block in Guyana is one of the most significant oil discoveries in the last 15 years, with low production costs that are expected to fuel Chevron's production and cash flow well into the 2030s. Warren Buffett's endorsement. The substantial and recently increased investment by Berkshire Hathaway serves as a powerful validation of the company's value proposition and management strategy from one of the world's most respected investors. B. The bear case. Navigating headwinds. Despite its strengths, Chevron faces a number of significant challenges and risks that form the basis of the bearish argument. Commodity price dependency. Ultimately, Chevron's profitability is at the mercy of global oil and gas prices, which are notoriously volatile and influenced by geopolitics, economic growth, and OPEC decisions. The sharp decline in earnings from the 2022 peak serves as a stark reminder that the company's fortunes are not entirely within its control. The energy transition. The most significant long-term threat is the global shift away from fossil fuels toward renewable energy sources. Critics argue that Chevron is not investing sufficiently in this transition, pointing to data showing that investments in low-carbon energy sources made up only 0.2% of its capital expenditures from 2010 to 2018-51. This has led to accusations of greenwashing, where the company's marketing on a lower carbon future is seen as inconsistent with its core business operations and investment plans. Regulatory and legal risks. The legal landscape for energy companies is becoming more complex. In the United States, the Supreme Court's recent decision to overturn the Chevron deference doctrine, a 40-year-old legal precedent that gave federal agencies broad authority to interpret ambiguous laws, could lead to greater regulatory uncertainty and more litigation, making it harder for companies to plan long-term capital projects. Execution risk. While the Hess acquisition is strategically sound, its execution was fraught with challenges. A protracted arbitration dispute with rival ExxonMobil delayed the deal's closing by over a year, costing Chevron an estimated $3 billion in lost profit from Guyana in 2024 alone. This highlights the inherent risks and complexities of executing mega mergers in the competitive energy sector. BIGS, essential due diligence, important checks and balances. A thorough analysis requires looking beyond the company's own numbers to its position in the industry and the non-financial risks that could impact its operations and reputation. A. Competitive positioning, a supermajor among supermajors. Chevron is a dominant force in the global energy market, but it does not operate in a vacuum. Its primary competitors are the other integrated supermajors, ExxonMobil, Shell, BP, and TotalEnergies. Market capitalization. With a market cap of over $300 billion, Chevron is the second largest U.S. oil and gas company, behind only its historic rival, ExxonMobil. and consistently ranks among the most valuable companies in the world. Production volume. Producing over 3 million barrels of oil equivalent per day, Chevron is one of the world's top non-state-owned energy producers, with a scale and geographic diversity that few can match. Financial strength. Compared to many of its international peers, Chevron is often lauded for its superior balance sheet strength and disciplined approach to capital spending, which translates into more consistent shareholder returns through the cycle. B. Headline and reputational risks beyond the balance sheet. Investors must also be aware of significant environmental, social, and governance (ESG) risks that, while not always appearing on a balance sheet, can have material consequences. Ecuador litigation, the rainforest Chernobyl. Chevron is embroiled in one of the most high-profile and contentious environmental legal battles in history. The case, which it inherited with its acquisition of Texaco, involves a multi-billion-dollar judgment from an Ecuadorian court for the alleged deliberate dumping of over 16 billion gallons of toxic wastewater into the Amazon rainforest between 1964 and 1992. Chevron has refused to pay the judgment, alleging fraud and corruption in the Ecuadorian legal process, and has engaged in a costly, globe-spanning legal campaign against the plaintiffs and their lawyers. Greenwashing. Allegations. As mentioned in the Bear case, Chevron faces persistent criticism and formal complaints from environmental groups and regulators. These groups allege that the company's advertising and public relations efforts create a misleadingly green image that is not supported by its actual capital allocation, which remains overwhelmingly directed toward fossil fuel projects. These reputational issues are not merely abstract concerns. They carry tangible financial costs. The process of defending itself in the Ecuador litigation, for example, is estimated to cost Chevron around $400 million per year in legal fees alone. This is a significant and recurring cash outflow that directly reduces the free cash flow available for investment or shareholder returns, demonstrating a clear link between a non-financial ESG risk and the core financial metrics that investors monitor. 7. Conclusion. A synthesized view of Chevron. After a deep dive into its history, financials, stock chart, and strategic positioning, a multifaceted picture of Chevron emerges. A. Recapping the analysis. Chevron is a legacy supermajor born from the breakup of Standard Oil and built through decades of strategic acquisitions into an integrated global powerhouse. Financially, it is a case study in cyclicality, with profits rising and falling on the tide of commodity prices. Yet beneath this volatility lies a foundation of exceptional financial strength, characterized by a fortress-like balance sheet and elite free cash flow generation. This financial discipline has enabled an unwavering commitment to shareholder returns, most notably through more than 3 decades of uninterrupted dividend growth. From a technical perspective, the stock appears to be in a period of consolidation, trading in a wide range after a historic run-up in 2022, as the market digests a return to more normal levels of profitability. A classic valuation model based on the principles of Benjamin Graham suggests the stock may be fully valued or even overvalued, though this must be weighed against the company's powerful cash flow and dividend yield, which the model does not fully capture. B. The final word. Ultimately, Chevron represents a company at a crossroads, embodying the central debate of the modern economy. For investors seeking income and exposure to a best-in-class operator in the traditional energy sector, Chevron presents a compelling case. It is a resilient, disciplined, and shareholder-friendly enterprise with a clear growth path for the coming decade thanks to its strategic acquisition of Hess's Guyana assets. However, for investors focused on the long-term risks of climate change and the global energy transition, Chevron represents a significant bet on the continued dominance of fossil fuels. The company faces persistent reputational challenges and the existential question of how it will adapt to a world that is actively seeking to reduce its reliance on Chevron's core products. The decision to invest in Chevron is therefore not just a financial calculation, it is a view on the future of energy itself. It is a choice between the tangible, cash-gushing reality of today and the uncertain, lower-carbon world of tomorrow. Ultimately, the decision to invest rests with you. Our goal is to provide the deep, unbiased analysis you need to navigate these complex questions. Be sure to subscribe for more deep dives into the world's most important companies. And that's all we had for this video. We hope this video was informative for you. If you think it was, then please do like and share this video. Also, do not forget subscribe to our channel for such wonderful daily content. Also, if you are interested to watch the videos in Hindi, then you can also subscribe to EPK Capital's Hindi channel. You can also follow us on Instagram and Twitter. The details are in the description. For more information or for your personal financial advice, kindly connect with us on the details given in description. I will see you in the next video. Thanks for watching.